guys, today we are here with my good friend Dimitris, and we are going to engage in a insightful conversation and discuss two ideas we have been discussing so far a lot privately. So we wanted to share it with you guys, and hopefully this will create a blueprint for our next ideas showdown. And let's see how it goes. I think it will be a ton of fun. And before starting, I will shortly introduce my friend Dimitris. Basically, we randomly met on Twitter and we just started chatting. And he's pretty young. He doesn't have an investing background. He studies. He's in dental school, so pretty different. But yeah, we've been having a ton of fun researching companies together, and it has been really good to have a partner or such. So. I don't know if you have anything to add. You can just say it now.
You actually got it perfectly.
Okay, that's cool. So yeah, the companies we'll be talking about today are Evolution and Lumine. So I'll be talking about Evolution, and I'll go first, and then Dimitris will present Lumine's idea, and yeah, he will do it better than me. So I'll just let him introduce the company afterwards. So I'll focus on what I know. So basically, I'll start with a short business overview, and then just discuss the company as a whole and the investing idea. And this is a pretty well-known idea in the investing community. I mean, a lot of very good investors own this business, and it's pretty popular on Twitter too. So I'm sure the people watching this won't be, let's say, seeing this company for the first time, but still I'll give a newbie introduction to the company. Okay, so basically Evolution is an online casino game supplier, and this basically means they provide games for the whole online gaming industry. So you have two key players in the online casino industry: the suppliers and the operators. So the operators are the ones you go online and search, I don't know, BetClick, Betano, or DraftKings, whatever, and you actually go and play there. So these are the websites that have an interaction with the customer and with the player. But these websites aren't the ones actually creating the games, because as you will see in a couple of minutes, it's actually very impractical. So that's when the game supplier comes in, and you have companies such as Evolution AB, and they provide a wide array of games, and this allows operators to run their business and actually focus on just acquiring customers and basically getting the traffic on their website. So they basically are marketing companies, not really casinos. I don't know if this is very clear for people that aren't familiar with the industry, but yeah, I hope to be as simple as possible. And then we have the game suppliers, which are already touched briefly, and we have Evolution AB, Pragmatic Playtech, which is also a public company like Evolution, and they run these games and they make sure they run well, don't have any security issues, can't be cheated, because this is a pretty important part of the industry. Trust is one of the key pillars, and most importantly, they basically make sure these games are fun to play, because if these games aren't fun, players won't play it and operators don't want it, so game suppliers have no business. So that's their main, let's say, task, is creating games that people want to play. Then I always like to, when I look at companies, it's pretty important to look at what problem they solve or what's their value proposition. So basically, it turns out that running an online casino table is a bit more complex than setting up a camera and filming yourself dealing cards or whatever. So you have to recruit to make it profitably. You have to recruit basically an army of dealers, and that's not easy because you have to set up academies, just like Evolution has his academies. Then you have to think about the game mechanics and make sure that you are compliant with regulation. And you also have to have like the right licenses to operate legally and so on. If you want to be like a serious player. And also another issue is that you can't just run like a single game, because operators want a wide array of games to basically integrate in their platform and not just like buy a single game from like different providers. So yeah, basically this is not a bit easy. And especially now that people get bored in 10 minutes, like every single casino player wants more games, more choices, and not less. So, like Jeff Bezos says, like he said, like I can't imagine a future where customers want a slower delivery speed or higher prices. I can't really imagine a future where players want less games and more boring games. So that's like a big reason why these suppliers have to have a wider range of array of games and yeah, basically have a big portfolio. With that said, if you run the maths, running a live casino operation is quite expensive, and it requires a certain scale to be profitable, and a lot of know-how because of all the reasons I mentioned before. But without like running into the actual maths, because that would be too boring and you would fall asleep. The bottom line is that you would have to have players bet 67 euros every hand, 50 times an hour, every single hour of the year for a blackjack table to be more profitable for the operator. So like the operator actually building a blackjack table and running it, than buying Evolution's live casino service. So this is very, very hard. Like, can you just imagine someone spending like 67 euros every hand, 50 times an hour? Okay, that's pretty crazy. So yeah, it's really hard to achieve, and that's why Evolution, that's where Evolution comes in, and not just Evolution, like I mean, all the game suppliers, they basically have to run these operations at scale and so on. So now that we understand a bit better what they do, let's take a look at how they make money. So there are a couple of ways they make money. I divided them into three categories. And you have like commission fees. So basically, you have this jargon word which is GGR, and it means gross gaming revenue. In simple terms, is basically the revenue this business makes from losses of players. So if you bet 100 euros and lose 10, you have 10 euros of GGR. Yeah, so Evolution takes a fee of that GGR made from operators. So let's say Evolution supplies games to operator X, Y, and Z. If they make like 100 euros of GGR, Evolution gets a cut between 7 and 15%, depending obviously on the size of the operator, how much time they have been with Evolution, and the terms of the contract. But basically, they get money from the players' losses, and you can see why this is a pretty attractive proposition, because first of all, the house always wins. That's one thing, and secondly, once you build a game, it continues to generate GGR, and you don't have to. You still have to have the fixed costs of having the dealers and so on, but the development part and the R&D, which is the most expensive one, it's already done. So you can basically earn money from a very popular title for a long time if it's a really good game, and if it's a hit like Crazy Time and so on. So yeah, that's the branch number one of how they make money, so commission fees. Then you have branch number two, which is branded tables and casino customization. So basically, if you see there's a pretty fierce competition among operators, you just go watch a football match or the Super Bowl, and you see how many casino operators are advertising on those events, and you can see it's pretty hard to gain market share, and it's basically a commodity, to be honest. So players go to the casinos that have the best discounts or the best bonuses. And I mean, when I say casinos, I say operators. So these websites that provide these games. So basically, a solution that these operators have is to create a brand. To create a brand, they need branded tables. So basically, to make sure they have capacity for their players, they can like buy this service from Evolution that's a dedicated table for their operations. And this not only creates like has the environment of the casino, like the branding, the logos, and so on, but it also like allows them to have a guaranteed space for their players that want to play. There's a limit, even though it's pretty scalable. There's a limit to how many players can be in a blackjack table, just because of bandwidth and like the limits of the physics of the business. Let's say. So if they have a dedicated table, they enable, like, they guarantee that they have space for their customers. And at the end of the day, if they don't have space for their customers, they are losing money. So if I want to go play and go to DraftKings website and I see there's no capacity on the blackjack table, I just go to I don't know, another website, so I don't care. It's just open a new tab and it's easy. It's not like you have to drive 2 hours away and go to another casino. And also there's the casino customization. So basically this includes the environment and basically VIP services. You have some special tables for poker and blackjack and so on that enables like VIP customers to go there. And they also cater to specific geographies. So the dealers of these games usually speak English, but if you, let's say, have a very good customer base in Spain, which is a country that doesn't speak English all that well, so you can ask Evolution to have like a customized dealer that speaks Spanish to cater that geography, let's say. And you also have other income sources such as setup fees, which is like, these are little things like the fees operators pay to set up their casino with Evolution, so the integration with Evolution. And as you can see, Evolution model combines variable and fixed income. So the fees from GGR depends a lot on how many players are losing money and how much money they are losing. And that varies with let's say the industry as a whole, but also the quality of the games, and that's variable. So the more players play, the more money they get, and the better their games are, the more money they get. So that's a variable thing. And you also have like fixed income, which is the branded tables and the setup fees. Basically, these are pretty standard and they don't vary a lot. And I think that's a good combination to have in every single software business. So some recurring revenues and also some non-recurring. And the cool thing is that they have like zero marketing spending on a B2C basis. So direct to the customer, they don't have any spending. They obviously have some spending like B2B because they go to fairs and they have to pay like the stands and so on. But yeah, compared to how much money operators spend to acquire customers, they spend like zero basically. So it's pretty cool that they get the benefits from the advertising spending from their clients, but they actually don't have to participate in that spending. So it's pretty cool and reduces operational complexity because they just focus on making good games. Like when I say just, it's a bit it seems easy, but it's not actually. But yeah, they can focus on the essentials. That's my point. So now that we've broken down like their revenue models and how they make money, I'll just go to the key metrics. And I don't think this was even needed, but for someone looking or listening about this company for the first time, maybe it would be a cool surprise, because this company basically has the best metrics that you can find out there. They have like 100% gross margins, 62% free cash flow margins, 4-year average ROE of 23%. And I did 4-year because it dropped a lot, so I didn't want to skew like the averages and so on. So for the last 4 years, it was 23%. Then you have 49% revenue growth on a compounded basis over the last 10 years. So they have also no debt and 16% insider ownership, and the founders are still on the board. So this is not an owner-operator business. So the founders are not actively managing the operations, the day-to-day operations, but they are still on the board, and they do have an influence on the decisions made. So I guess that if the CEO is making more than acquisitions, they can fire him if they want, basically. And the share price performance has been 60% annualized on a compounded basis over the last 9 years, doubling on average like every 1.2 years. So that's completely crazy. And there are a lot of happy people in Sweden that have become millionaires thanks to this company, and they are big fans of their management team, let's say. And that's what we are going to talk about next, management, exactly. And when it comes to management, we can't help but talk about Todd Haushalter and Martin Carlson, which are both the CPO and CEO, respectively. And Todd basically is an energetic, very creative and passionate individual. He's one of the biggest experts in gambling, in the gambling industry, and he's the CPO, so Chief Product Officer. He deals with the game creation process and all that kind of things. And he's many times compared to Steve Jobs, so in his industry. And I don't know if this is a good comparison, but they do compare it with him. So yeah, I just thought about mentioning that. And I think he's a crucial pillar on Evolution's continued success, at least on the long term. Because, I mean, if you watch one of his last interviews, he answers this question about what would happen to Evolution if he left and so on, the risks associated. And he answers like, okay, the players don't care if I'm on Evolution's, like creating games for Evolution, they just care about the games. And they will continue playing if I die tomorrow, and they won't care. Basically, this was his answer. I do agree to a certain extent, but what about the next, let's say, branch of games they will launch? Like, who will create them? Like, Evolution doesn't rely only on the games made on the past. It also has to develop new games. So basically, I think it's a long-term risk and not a short-term risk, because, as he said, like, players will continue to play a year, 2 years from now, the same games they were playing, and they won't care about Todd, unfortunately. I think he's a great guy, so they should care, but I don't think they would. So yeah, basically the risk is on the long-term side, and I will talk about this at the end. And he owned 96,000 shares as of 2022, with rights through warrant program of 120,000 shares from 2020 to 23, and then like some more shares on another program. I won't be too hard on the numbers because this is already getting too big of a pitch. And then we have Martin, which I regard as more hardworking and concentrated on the operations, so not so creative and so on. And I don't think he's too much of an investor, so to speak. So I think he's a CEO that focuses on the operations, basically, and not so much on the capital allocation. Just because of some of the acquisitions they made. So NetEnt for 1.8 billion in 2020, Big Time Gaming for 450 million in 2021. No Limit City for 340 million, which are all doing RNG, which are slots, so those random number generator games. And this is basically a commodity with worse unit economics. So the multiples paid for these acquisitions weren't all that like rational. So that's why I'm saying he's not like the best capital allocator out there. Some would call it even a bad capital allocator. But yeah, there's some advantages to these acquisitions, like buying them time in the US market and getting faster at entering markets and so on. But yeah, the acquisitions haven't played out yet, at least how they said they would. So that's why I don't think he's a great capital allocator, but great, intelligent people and smart people learn from mistakes. Hopefully, they won't be doing these kind of acquisitions. Especially, I mean, they can continue doing acquisitions, but not with the share issuance and diluting shareholders and so on. Yeah, so he has a lot of shares on Evolution, like more or less 80 million euros in shares, and that's a lot for someone that's not the owner of the company. Yeah. I would also highlight some other points to wrap up this management discussion. The average tenure is from 7 to 18 years for upper management. They have compounded free cash flow per share at 61% CAGR since 2014. The founders are still on the board, so that's an important point. And 16% of the shares are owned by insiders. So, yeah. And now, briefly touching on the moat of the company. The first thing I can see when we speak about the moat is the relationship with operators, because this is crucial. As we said before, trust is completely essential in this kind of business, and the fact that they basically make operators, so their clients, rich every day, it's a pretty good incentive for operators to like them, and they have a customer base of 800 customers, and these are not like small players. These are companies that are making billions, so that's why they also have a lot of concentration. I think the top 10% of the customers make. I don't know the numbers, but yeah, they are very concentrated in terms of revenue, because their biggest customers make the most money in the industry. So inherently, they are going to be a big chunk of their revenues and profits. And basically, these relationships are very sticky, because once players get addicted, okay, this sounds a bit too harsh, but once players get used to playing Evolution's games, they don't want to switch to other copycats, and they are used to the mechanics, they are used to the dealers, used to the lobbies, so all that stuff counts. So that makes the business pretty sticky, and operators, I'm pretty sure that if they could not rely on Evolution, they would. So if they still pay Evolution a big chunk of their profits, it's because it's a rational thing to do, at least from my point of view. Maybe they are not so rational, but yeah. Then you have also the economies of scale. This a metric that I would like to highlight is that their free cash flow per employee has grown at a staggering 20% CAGR since 2015. So they are making more money per employee as they grow, and this is a clear, let's say, proxy for economies of scale. Basically, they can leverage their employee base and their resources to make more money. Obviously, this is not like a direct causal effect, so it's not just because of scale. Maybe they are getting better, they are making more games and better games. So, but still, basically, it's pretty obvious that they are making. The more players play the same table, the more money they are getting for the same fixed cost. So that's obvious. for the moat. And third, it's like the superior product. Like basically, they are making the best games, and they are innovating and making better games each year. And you can just watch the other players in the industry, other um, providers of games, and they are just basically copying Evolution, at least on the live casino side. And it's well known that they are quasi monopoly, maybe duopoly. So yeah, that's I would say that's a pretty strong moat. A lot of people don't see it because it's also these are the three big things, big ideas, and you always look for the big things. But in reality, they are doing a lot of little things right, and that's also I think that moves the most weight. I don't think it's these three things that I mentioned. It's a lot the things they do day to day that really make the difference, and it's hard to see because you're not like watching them closely, at least on a day to day basis. So to finish my pitch before going to the IRR and valuation and so on, I want to do a thought experiment and say how can we lose money on this. And I have a couple of reasons why we could lose money in the future. The first one is if Todd leaves, and he laughed about this on the interview he gave with iGaming Next, but I think it still holds true. If Todd leaves, we could lose money. Then you have reputation. So if the reputation gets hammered, if they actually lose customers from, let's say, bad reputation, I would be concerned. So they have been. There was a short report a couple of years ago, maybe 2021, but they didn't really lose any customers. So it was just like a hit on the stock price. But that doesn't really matter, and it actually makes them more robust over time because as shareholders get used to short reports, they next time they see a short report, they will actually like, oh, it's okay, as long as they don't lose customers, you know. Then you have technological adaptation and medium change. So if things go to VR, AR, just like land-based casinos saw a switch to online, they can see a switch to other platforms we can't even imagine. Then you have the competition. So players like Playtech, Pragmatic Play, and all the other competitors may eat up their margins and so on. But so far so good. Their track record is pretty good on that side, but still it could be a possible thing. Then the fifth reason is valuation. So if you buy at the wrong price, maybe you won't be so handsomely paid afterwards. And the sixth risk is unknown. So I always like to account for things I can't account for. So I really think the biggest risk is what we can't see, and everything can happen really. So there's always that risk. And I made like a little decision tree based on like this very famous bridge player that does these decision trees and attaches probabilities. So I decided to copy him, and obviously I didn't copy him that good because it's just an experiment. But anyways, I think there's a 30% chance of outsized returns over the next 10 to 15 years. So this is a scenario where shareholders see their investment, let's say 10x or something. And this implies that there's a 10x in free cash flow per share, assuming that's a good proxy for stock price performance. Then the number of tables they run, so blackjack tables and so on, would have to bump up to 9.3K, more or less. They now have, I think, around 1.6 thousand tables. So yeah, that would need to go up. Then they would have to have 100,000 employees. This is because they rely heavily on dealers, and they have to have a lot of dealers. So I think this is pretty possible because there are a lot of companies that have more than 100,000 employees, and they manage to recruit and so on. So I don't think that's a natural or physical limit to the business. And then they would have to have 8% market share of the online gambling industry, and I think that's also achievable. So that's why I attached the 30% probability. Then the scenario where you make some profits, but not, let's say, outsized. I think that's a 48% chance around that. And again, I would like to say these are obviously going to be wrong predictions. I'm just attaching numbers to it to showcase the degree of confidence I have in these outcomes, not really to say, okay, there's literally a 30% chance. It's not that way. I just want to be able to see this video in 10 years from now and say, okay, you were so stupid. And so that's why I'm attaching numbers. Then I think there's a 2% chance of flat returns, just because this is a very sensible company, because they've been growing so much. So I think they either will have outsized returns or negative returns. So flat, it's not really a scenario I can feasibly see, in my opinion, because if their margins erode, their multiples would go down too, so they would have negative returns, not flat. I think there's an overall 15% chance of negative returns, and that's mainly attached to things I can't predict, and 5% chance of massive losses. So that's a big permanent loss of capital. And yeah, that's basically it. I hope you didn't fall asleep while I was talking. But I would also like to finish and finish my pitch with a valuation of sorts. I think with under conservative estimates, and I will put pictures of my model and so on, so I don't have to say the numbers, list the numbers. I think there's a pretty good chance of getting at least 11% IRR over the next 10 years. And that's under conservative estimation. So again, to attach a number probability to this outcome, I think there is a 78% chance, or I have a 78% degree of certainty that this will happen over the next 10 years. Yeah, that's a wrap up. And now I'm open for questions from the public. And since you are the only one listening to this, yeah, you can ask questions.
So you actually talked 30 minutes straight. You did an amazing job. Yeah, David also has a great video on constellation evolution. He compiled all the data you can actually find on this company, so was very educated. My question would be, how do they keep those outsized or abnormal margins when faced with competition? As you previously told us, their biggest competitor is Pragmatic. What if someone could fund, let's say, Pragmatic, or try to create an other evolution with Todd or something else? Would they take talent from evolution? How do you view this scenario?
Yeah, that's a very good question. I think that's the best question you can ask yourself in this case. So thank you for the question. And I think it's pretty likely that margins will erode. And if you look at the past track record, you would see like continuously better margins, increasing margins, and that's pretty abnormal. And at the end of the day, things end up reverting to the mean, maybe. So we don't know. it might be so, but I can see a case where margins go down. I think that the biggest question here is not if they will go down, because that's pretty likely. The question is, will they go down to a point that means that they lost their competitive edge or their superiority? And as long as the margins are well above the 40% range, like at least on gross basis, I think they have a pretty strong moat, or at least business model. So again, like their margins are what, 100% gross margins. They still have a lot of room to go down and still be a great business. And I think that's the way I would address the question. Obviously, I addressed the question, maybe I answered to a different kind of question, but that's the question I would put myself. And there's still space for, as I said before, to get a 10x, you need like 8% market share. You still have 92% left for the others. So yeah, margins can erode, and most likely will, and you can still get a pretty good outcome, not just on your investment, but on the company. And obviously, when margins erode, you get the question of retention of talent and thought and so on. As long as they are still the biggest player with the biggest resources, they will still attract the greatest talent. And as long as they have unlimited budget for their games, Todd, at least from what he says, and I think he's an ethical guy. He said that he would stay on the business because at the end of the day, you want to have room to do whatever you want with your ideas, and so if he has that ability, he will stay. I think so. That's my answer.
Pretty good answer, I would say. My next one would be mostly about capital allocation on this business. I think they have like 40% of profits or 50% on dividends. And maybe my problem is that they also use a lot of capital in not shareholder value creative acquisitions. Do you view it as a risk, or do you think actually their best choice would be just buying their own stock because they're a good business, I would say, and they would
Yeah,
create better returns on that? What's your view?
that, yeah, that's a very good question too. So, just off the top of my head, I think that their capital allocation, as I said before, wasn't the greatest in the past. They have made a couple more acquisitions since then, since that shopping spree, um, and it seems like they have changed a bit their structure. So they are doing more like earnouts and not so much upfront cash. With life spins, like it was the last acquisition they made. It's very little upfront cash, and most of it will be earnouts because, from what I understand, basically their acquisitions run pretty decentralized. So they centralize like the 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 key things like accounting and so on, but the game creation and the teams run separately. They have their own offices. They don't share space. So they are just under the Evolution umbrella. And I didn't talk about the OSS, which is the one-stop shop. And that's like an integration of all the acquisitions. And maybe, just maybe, these acquisitions will take a bit more time that we are used to play out. We don't know, but I think that as long as they don't pay again those crazy multiples for other companies, and I don't know if there are any more companies left for them to buy it, like at least the big ones, like Netflix and so on. So hopefully they won't engage in more acquisitions like that. I think the best strategy would be to buy the little companies that really make a difference for them, like DG wheel. Basically, all the other players in the industry have to pay them a royalty to use that technology, and that's pretty funny to me. Like your competitors are giving you money, so that's cool. But yeah, regarding the share buyback, they did start a share buyback program. I think with the influence of a lot of investors. But yeah, it's hard to tell because if they're not buying good at buying other companies, yeah, I don't know if they will be good at buying their stock at the right time. They did start buying at a good time, in my opinion. I don't know if they will continue to do it at let's say to do it on an opportunistic basis. That's basically what I'm trying to say because they just start buying like randomly. It's not really that value accretive for shareholders. So yeah, and about the dividend, I don't think really they could reverse that extra 50% at attractive rates. So that's why they pay a dividend, and also in Sweden, like it's pretty much standard. You look at all the companies and they all pay dividends, and what they say is, yeah, I want the money. So the founders want some income, they want to get some money out. Obviously, maybe that's not the best and that's not the most rational thing to do, at least on a long term basis, because obviously it would be better if they could reinvest the money. But again, I prefer them giving me 50% of their income, at least like obviously on a fractional basis because I own like two shares. But I prefer them giving me a dividend than investing that money at high risks. So um, yeah, ideally, on an optimal world, they would be reinvesting all that cash back into the business at like say 33% return on capital. But yeah, that's unfortunately I don't think it's possible. Even though they spend a lot of money on game creation, yeah, that's still hard to do. So
Okay, perfect.
that's it for
Uh,
you.
yeah, that's actually it. You
Okay.
covered almost everything. Sometimes I want to have a question, but you just answered right along. Yeah.
Okay, cool. Yeah, and just a quick note: if the I always love when someone leaves a comment down below and challenges my assumptions or whatever I said. Most likely, I made a lot of mistakes in my pitch. So if you if you spot something, just leave it down below in the comments or send me a private message. I'm happy to yeah to receive those feedback that feedback. So yeah, I think that's a good time for you to start your Lumine pitch, and hopefully people didn't fall asleep, or if they had, um, I don't know, but I'll put timestamps so if people just want to listen to Lumine, they just listen to you.
So basically, the company I'm gonna present on this pitch is Lumin Group. Lumin Group is a spin-off of Constellation Software that is focused on media and telecommunications verticals. Um, the company is run by an owner-operator, David Nyland, which founded the Lumine portfolio within Volaris Group of Constellation, and has been spun out to use the shares that are trading on the TSX Venture to buy Wide Orbit. The business model that this company has, it acquires, strengthens, and grows vertical market software companies in the media and telecommunication industries. It's a buy and hold forever acquirer of these businesses, and strengthens their profitability and accelerates the growth with the use of their playbook. Uh, One of their acquisition criteria are that they are vertical market niche, or number one or number two share of their niche, uh, proven mission critical software, that solves the operational needs of their customers. It has low churn rates, and the average acquisition size is 11.7 million, compared to, let's say, Constellation that buys businesses that are a lot smaller. This number is an average of the small operator type of businesses they acquire and the large carve out transactions they have. Um, the type of deals that they have are three: corporate carve outs, divestments, and the owner operators, as I said previously. Um, Constellation is generally more focused on doing carve outs. By carve outs, what I mean is, let's say, the Nokia deal, where Lumine purchased the service management and device management service from Nokia, uh, which had the Motiv and M-Formation brands, and Nokia combined those two brands and didn't have the decentralized management, and basically he bought those two companies and split them up, which many PE type of uh, business models acquire and don't have the courage to split them up or refine them in order to be profitable. And in those type of deals, you have, let's say, motivated sellers, and they're more value creative if you know how to run and restructure the businesses, which takes a lot of skill, a lot of practice, and also one advantage of Constellation's business model is actually that it is counter-cyclical. When capital is constrained, sellers get desperate and they sell out their businesses at very value creative valuations, which makes Constellation or Lumine, let's say, have uh, helps them meet their hurdles on their acquisitions. Also, many large companies that have orphan businesses within them, they may be more motivated to sell them out to businesses like Lumine or, let's say, Constellation, because they're a natural and experienced buyer of those type of deals. The mode of Constellation and Lumine too, because they acquire the same businesses, the same type of businesses, is the stickiness of the product, the relatively limited number of competitors in each of the verticals, its intimate knowledge of their needs, and being able to deliver highly target verticals, very customized solution, which is the opposite thing of many software companies. On the acquisition side, their best practices are they are very disciplined on their capital allocation. They have a very large database of companies and knowledge of carve-outs, and also being a permanent and competent business owner that acquires businesses and holds them forever. There's no exit for them, like let's say PE firms, which their whole strategy is buying businesses to get an exit on a higher multiple and get their return on that way. Many founder operators may prefer Lumine to PE firms or copycats because they get buy the business even if it's not the highest bidder, but they run the business as their own and they don't destroy their darling, which many people that created those type of businesses took decades of their life to create such companies. Their addressable market is very large and gets larger by the day, I would say. Just like Constellation. Um, there's actually research from Galileo Capital, which did an interview with David Nyland. And on this interview, they said that they're looking at around 4,000 of those large type of deal, we're talking about companies that are sized between 4 million to 100 million. So the market is extremely big on that aspect. And them being focused on media and telecommunications only, it's not capping out their addressable market at the moment. Uh, David Nyland has told us in a 2022 annual meeting that they have at least 10 years of buying other those type of deals before looking at something else, like Constellation right now has a venture arm, or was looking at buying some oil assets in 2020 2019, which were very distressed. So there's tremendous amount of runway, to put it simply, to buy those type of deals. Uh, Next, I'm gonna touch on the spin-out and the wide orbit deal. Uh, Lumine acquired wide orbit for 490 million. For this deal to go down, uh, Lumine used 180 million of cash, which came from Constellation, let's say. 87 million of debt, which was on Wide Orbit's balance sheet mainly, and 222 million, which came from issuing of special shares. They basically rolled over the shareholders of Wide Orbit to being shareholders of Lumine, which creates alignment and gives them something that holds wide orbit permanently. Uh, those shares that they issued, the special and the preferred shares, uh, the special shares are the shares that wide orbit employees and management holds, and the preferred are the ones that Constellation had. The others are the subordinate voting shares, which are the shares trading on the TSX Venture currently, and were given as a spin-off to shareholders of Constellation. Um, so I'm gonna give you the numbers of how many shares are around. CSI shareholders own 63,000 subordinate voting shares. CSI directly owns 63,582 preferred shares, and one super voting share currently, which has 50.1% of the voting rights. And special shareholders own 10,000 shares. This is all gonna change in March 24, because those shares are gonna convert to subordinate voting shares. One preferred share will convert to 2.4 subordinate voting shares, and the special shares will convert to 3.4 subordinate voting shares. So the final uh, share count on this company after the mandatory dilution would be 253,000 shares. Uh, the current shareholders that have shares you can buy on the public market are going to get diluted from this type of structure. But it will also give them 80 millions in 64 million in dividends that will come out from this dilution, because those shares have a 4% or 5% dividend yield currently, that's not going to acquisitions. So after the deal, we have a lot more money to be put on the acquisition engine. Um, so basically, I'm gonna go to the number section and talk about uh, how do the financials, and from that point, I'm gonna go to the valuation. In general, the best KPI to look at Lumine would be free cash flow available to shareholders. It's the money they can put on value creative acquisitions. That number currently is at 88.8 million. After the dilution, we're going to have the 88.4 million plus the 64 million that is used. Currently, they're using like around 80 million in the dividends, but the other would be financed through with the share issuance. And I think a press release came like 1 month ago that they're going to try to issue more shares. So basically, the share count may be higher than this. So getting both of those numbers together, we're looking at around a round number of 160 million with a company that has a market cap of 1.7 billion. I'm gonna try to convert the numbers to Canadian because it trades in Canadian dollars, and the financials are on US dollars. In general, looking at the statements of this company, they're quite complex, I would say. That's because of the accounting treatment the of the conversion of the share conversion. They're basically reported as losses. So looking at the financial statements, it's pretty hard to get the numbers that most value investors want, and we also don't have many years of this company being a public company. The whole arbitrage situation on this is that it's misunderstood. If you look at this a company trading on the TSX Venture, which in general has many speculative biotech mining type of stocks. If you look at the description that it has, you don't know that it is a spin-off of Constellation Software, a computer, or cannot get this valuation right. Um, so me doing the valuation, I don't like discount cash flow models. I like to do a simple valuation on those on my companies. I would say the companies I research. Generally, Constellation has a track record of doing 30% uh, returns on capital, which are pretty astonishing, I would say. I'm not trying to forecast those type of numbers, but the best way to look at the stock performance, I would say, the returns you get as shareholder, are that you have the ROIC plus the growth that the companies have. The Lumine portfolio, if you look at the prospectus, had around 27% ROIC and pretty low growth, I would say. It's not that high as Constellation currently, but we don't have many years of financial statements to have a forecast on grow. But if we have a company that deploys 170 million at, let's say, a conservative number of 25%, uh, which from many points of view, it's not conservative, but actually, many people doubted that Constellation can put so much capital at that type of rates, and they continue to do this. Their previous year was actually very good. They deployed even more capital at very high rates again. And I think that Lumine has less problem on deploying so much capital than Constellation due to them being having a lot lower base. They're the size of Constellation was in 2011, I think 2014. They're a lot smaller than Constellation currently. Um, but when you compare the valuation that Lumine has compared to uh, CSU, it's a very hefty discount, I would say. So I'm gonna go to relative valuation, compare both of the businesses. Constellation Software trades at 52 times free cash flow available to shareholders, while after the dilution, which comes in from the point of this video being recorded in 14 days. So basically, I'm going to use the converted numbers. We're looking at around 11 times. So a lot lower multiple. We don't know what the market cap will be on the day of the conversion, but what we can get is that the per share free cash flow available for acquisitions is around zero point 0.6. So whatever the stock price is, divided by that and look at the multiple. If we look at the operating cash flow from operation, which is another good KPI for Constellation, Constellation trades at 33 times, while Lumine trades at around 11 or 12 of that multiple. A fair multiple, I would say, for Lumine not being that well known and at least not as well known as Constellation would be 20 to 25 times. So just from the multiple expansion, from the multiple going to 12, from 12 to 24 or even 20, we're looking at a 3-year return of 24%. And we have a business that compounds its own intrinsic value at 24%. If you add both of these up, we get a 3-year return of 24 to 45% CAGR. And it may sound very high, but I would say it's a rate that has some margin of safety because of the current valuation. The main risk is that the competition copies their playbook. Talent leaking from Lumine to other competitors. And the biggest one, I would say, that destroys the returns they have on their acquisition is the inflated acquisition multiples due to many of their competitors using debt and buying at very high prices. And that will not help them meet their hurdles.
Yeah, so that was a pretty good overview on Lumine, and I think experienced investors and like just new investors got a pretty good understanding because yeah, you gave the whole thing, so that's cool. Now I would move on like to more of a conversation, or let's say I would ask you some questions about Lumine if you're okay with it. And actually, the first one that's really I'm very curious about is that Topicus. I don't know if you saw, but they issued a special dividend recently, and
Mhm.
that was because they couldn't reinvest their capital, all their capital. So they actually couldn't put all that capital to work, and they're pretty small, let's say. So not at least relatively to Constellation. So what I'm trying to say is that even though Constellation is able to redeploy that capital at very high rates and most of its capital, maybe since this is a decentralized model, and with decentralized I mean that each branch runs independently, and they allocate capital independently, make the decisions, and so on. Maybe what about if they can't reinvest all that capital, and even at their size? Because as you said, if multiples expand or PE firms, which is private equity, by the way, if they start having cheap debt and so on, maybe they won't be able to redeploy 100% of their capital. And I don't know if that's fully covered on your margin of safety. So how do you think about the possibility of them not being able to redeploy all that capital, and especially knowing that they are a different structure from Constellation? So David Nyland, I'm pretty sure he's super smart and very intelligent and high quality individual, but he's not Mark Leonard. So they're different persons. And how do you think about the risk of extrapolating like the track record from Constellation to
So basically, my point on Topicus not being able to deploy all their capital is that they're mainly focused on owner-operator type of businesses compared to, let's say, Lumine, which is more on carve-outs. It's hard to get those type of deals which are the best at creating shareholder value, getting a lot of these every year. Some years they may go ham, some other years they may not be able to deploy the capital. That's why they issue the dividend. There's actually a case that we may get those type of deals with Lumine too. The good thing is that they have around 170 million to deploy, 160 million to be correct. Uh, there's a very active pipeline, as Nyland said in the 2022 call, and the targets that their targets are in general very large. So basically, if they do one or two acquisitions per year, they can give all of their capital to acquisitions, or maybe even more. So it is a scenario that exists that they can deploy their capital, but I don't think it's likely, let's say, to a 5 year outlook.
Yeah,
The best thing I would say for this company is if we go in a recession, which many companies may not do well, and a recession is not bullish for many companies, but for telecommunication type of industries, which mainly remain stable on recessions, who doesn't pay their telephone bill, uh, even if there's a recession, uh, they can actually deploy capital at more of these carve outs and maybe leverage themselves when multiples of the owner operator type of businesses drop, which it's because many of them organization are not willing to find, they cannot find buyers on their companies.
yeah, um, yeah. I asked this question, but yeah, I think that's a fair point. And the other thing I would like to for you to address is that the customers these companies they are buying are yeah, the customers that they are addressing in these verticals are pretty different from the ones you see in other types of subsidiaries of Constellation. So basically, they have big customers such as Vodafone and all these other telecommunication giants. And how does that how do you think about the difference in type of customers? And can you elaborate on Lumine's measures for customer retention and revenue diversification and so on? Because these big businesses usually don't rely on just mission critical software. They have many software providers, and maybe they have more ease at switching. So, have you seen any pattern on the churn rate? And the churn rate, I mean, the customer retention. So, how many customers leave? So,
Um, there's a big difference between Constellation and Lumine. Constellation, let's say, has 50% of the revenues coming from government type of software, and Lumine is mainly focused on enterprise software, which is a different type of software, I would say. It's more competitive, for sure. But I think the market and them having many subsidiaries restrains that risk, but the risk is there, at least when looking at yeah, the risk there.
okay. Um, yeah, makes sense.
I would also add that one advantage they have to Constellation is that they have slightly better margins, uh, especially Wide Orbit has great margins and has a great retention rate. Weatherbit, which is their biggest acquisition, has 99% renewal, which is actually astonishing. It's a very high quality business. David Nyland has actually addressed it in the 2022 call. In general, when you look at Warner Research, Constellation, or Lumine, I would say the annual reports don't say a lot, and that it's actually a mode of the company. They don't discuss their processes very much. The best way you can get information about these companies are the annual calls.
Mm. Yeah, I agree. I watched the 2023 annual call, and it was really nice. And thank you, by the way, for pointing it out. It was cool. Maybe I'll leave the link down below. Um, uh, Another question I really have, and maybe this is a very basic question, but for example, let's say Lumine needs more capital than what they have. So let's say they are not able, they have more acquisitions to do than the capital they have, and so they need money. Would they ask for money to the parent company, so Constellation, or would they issue debt? So I know they have like revolving credit facility, but would they have like access to infinite capital basically if they need it, or would they have to? And if yes, at what interest and so on, or do they have to issue that?
That's actually a great question. Constellation had that problem too when looking at the 2008. If you read the letters of Mark Leonard, they didn't have a debt instrument that had a very long expiry date to acquire other businesses. Constellation currently has something that resembles what Leonard wanted in 2008, 09 type of years. They have long bonds, let's say 10-year bonds that currently trade, and they can buy businesses and get their return in let's say 3 years. So they have basically free money. Lumine is not on that size to get those type of bonds or those type of financing to be uh, good enough for them. I don't know a situation which Lumine maybe could use the bonds that CSU currently has to make acquisitions. This year they used a lot of debt to make acquisitions. They deployed 2.6 billion, and they had the free cash flow around 1 billion. So a lot more money going to acquisition that they actually produced. But them using it with earnouts and the way they structure their deals and the debt meets their hurdle rates and creates a lot of shareholder value. For Lumine, I don't think they can probably get so much money to deploy. That would actually be they would actually be blessed to deploy so much capital. But maybe they could use the revolving credit facility to buy other businesses. Uh,
Yeah,
that's it.
makes sense. And also, basically, to deploy so much money, you also need the structure. So Lumine doesn't have like all the M&A advisors and so on that Constellation has. So
It doesn't have
uh,
M&A advisors, but Constellation may give acquisitions that are on the verticals that Lumine is targeting, may give them to Lumine because they're a preferred acquirer of those type of businesses. Also, I would add that Constellation has a bigger customer concentration risk, but also has an advantage, which is cross-selling. It's very rare in the Constellation universe to have businesses that cross-sell other software to their existing customers, but it's a lot easier in Constellation,
mhm.
in
Yeah,
Lumine than Constellation. Yeah.
yeah, that makes sense. Yeah, and really the last question I would have for you, and I think we could wrap it up afterwards. Is the media sector in a secular decline? Because if you talk with Bogomil Baranowski, which I interviewed a couple of weeks ago, he speaks a lot about not entering industries in secular decline because, yeah, you want to have the winds blowing in your favor, not yeah, have headwinds and so on. So, do you think this is the case for the media sector?
Actually, the media sector is declining. Let's say TV advertisement has been going down for the last decade, but it's actually a lot more stable than people think. The businesses operating in those type of industries, even if the industries are contracting, are growing currently. So even if in declining sectors, the Lumine can actually get great returns, and it doesn't attract many competitors if the industry is constraining. But it is a risk that you need to keep in track. Let's say in 15 years. The risk is mainly on the media sector, but it's also in the telecommunications. They may get disrupted by newer software companies, but most of their businesses in telecommunication actually exist for 20 to 25 years. And let's say Vodafone or American Tower, their customers, are slow giants that if they move, they make cut themselves. So they're not very used to changing software providers.
Hmm. Yeah, that makes a ton of sense. Yeah, so I think we had two little interesting companies. I mean, not so little, at least in the case of Evolution, it's like 20 billion market cap. But yeah, two interesting businesses, which I believe are very high quality. Obviously, discussing the risks and the downsides is always like the most important thing to do because the risk you incur when looking at these businesses is that everything looks great and then you don't think about what can go wrong. So yeah, that's I think that's a good exercise at least. I hope you enjoyed our conversation and if you want to say where people can find you, like Twitter or something, just feel free to add your couple of words. Yeah.
Yeah, everyone can actually message me Twitter about Lumine. I would love to have a discussion. That's the way that I actually met David. We were talking about Technion.
Yeah.
Yeah, they can hit me up on Twitter at Kaplani Research, and yeah,
Okay. Sounds good to me. And I think that's a wrap. So
yep,
I hope you
that's
guys
right.
like it. And as always, leave some feedback in the comment. And yeah, see you next time.